Welcome to The Real Money Show, the number 18778 Silver, and the website guildhallwealth.com. My name is Jeremy Wiseman. I'm joined by Jerry Correia, and sit down, buckle up. It's going to be a big show just like the last couple weeks, hasn't it been, Jerry? There's just a lot happening news-wise in the cycle with precious metals. Also, there's so many dots being connected with week to week with everything that we've been looking at. So, one thing that we want to look at this week is one of the discussions that's been ongoing is buying gold with a but, meaning that there's a lot of articles and analysts out there who are reluctantly recommending precious metals. We still have entities out there who are ready to jump on any potentially negative news in the market to try to keep the prices down. But we're gonna help you just to sear through all of that information and stay with what's really, really important. Jerry, ultimately, with all of the debt and inflation, these are uncertain times. And ultimately, nothing is certain. Money is losing value as we speak. We'll talk about interest rates in a little while. But in uncertain times, gold is always certain, isn't it?
Absolutely. And with gold on your side, when you include gold and silver in the mix of your portfolio, it provides people with peace of mind with something that has been around as money for thousands of years. And the uncertainty revolves around the currencies, Jeremy. And it gives us a chance to step back and get a bird's eye view, really look at things soberly. So we implore people not to get too caught up on the day-to-day, maybe in the week and the monthly data releases. Instead, focus on how these feed into longer-term drivers of the gold and silver prices, namely the fact that 70% of physical gold and silver demand comes from the East, China, India, and even Arab countries, Turkey, and even that since the whole the Ukrainian and Russia, the occupation and the mission there, the central bank purchases have nearly tripled because of weaponization of the banking system, the financial system, and the SWIFT system. Countries have made moves, and as a result, people are doing the same. And definitely, and these are uncertain times, but certainty is found in gold, that's for sure.
Well, yes, that is part of the de-dollarization theme, that the U.S. dollar has been weaponized. The BRIC nations continue to make moves. I know they've got a big meeting coming up, I think in October. Last year, people were expecting big things to happen. Is it October or?
Yes, I believe it's,
okay.
Yeah.
Last year, I think people were expecting big moves. That didn't really happen. I don't think they were ready for that. Personally, I think we'll probably see some interesting developments at this year's meeting. Mm-hmm. But you were talking about the importance of having precious metals, and just a couple of we're always listening to different podcasts here, and we'll send out the really good ones to our clients. And one that came out this week was David Lynn was interviewing David Rosenberg, and the crux of the matter is he is bearish on the U.S. dollar, and therefore he is bullish on gold. And that was a quote from that show. Again, that goes to the idea that gold is negatively correlated to the dollar. It is anti-dollar. And when you have a U.S. dollar that you're just talking about being weaponized and countries moving away from it, and also adding to that the amount of money that's being created out of thin air. Just before the show, we were having a little chuckle because, Jerry, you said, do you remember Trading Places when they're trying to teach Eddie Murphy about commodities? And on the table, they have set up coffee. It's a commodity. You drink it every morning. They had pork bellies that might be in your bacon, lettuce, tomato sandwich. There's frozen orange juice. And there's gold, and then they pause.
Yeah.
And they say, of course, it doesn't grow on trees.
Such a good part. Definitely worth the popcorn that's popping around here, Jeremy. It's definitely a great movie that we're watching here.
Yeah, so ultimately, yes, gold does not grow on trees, which brings me to another podcast that I was watching this week, which was with Rick Rule. He used to work with Sprott. Amazing analyst in the market. And one of the things that he was talking about is they were exploring gold versus silver a little bit. And he obviously thinks things are moving much, much higher. And he always has a great way of phrasing things a little differently. And he said, I own gold because I'm afraid it's going to go to $7,000 or $8,000 or $9,000. And when I say I'm afraid, I really mean that the circumstance that takes gold to 9,000 is invariably a very unpleasant circumstance and would devastate other parts of his portfolio or someone's portfolio. And the point that he's making is that something that we have talked about for years, which is you shouldn't have to suffer on your lifestyle. I see people accepting that every day.
Yeah.
Oh, there's inflation. Okay, well, I just pulled back a little bit. Well, you shouldn't have to pull back a little bit because your government printed a whole bunch of money.
But they're telling you to skip breakfast in the morning, Jeremy.
Yes, and or the cereal companies are telling you to eat more of it for supper because you can't afford a real meal.
Yeah, eggs for dinner.
And we're not going to talk about all the stuff that's in those cereals that you shouldn't be having anyway.
That's true.
So, look,
we can go there.
The fact is that gold, despite what anybody might tell you about it, that it's a relic, it's a pet rock, it doesn't pay a dividend, it's volatile, all of these things, yet it's up over 500%. And I repeat it every week because it bears repeating. The fact is it's completely done its job over the last 20 years, and we're nowhere close to the end of this bull market. When we see the end of this bull market where, hey, Rick Rule's talking about $8,000, $9,000 gold, and he's saying, I'm worried about what that looks like just because it's going to be an uncomfortable ride. Why? Because most people don't have gold in their portfolio. So he's hedged. Right. He's got his insurance policy. He's saying, I'm holding this insurance policy because I'm afraid it could happen. I'm afraid this boat could sink. And I want to make sure that I'm going to be on one of the life rafts.
That's right. That's right. And as we're reporting this today, silver and gold are up. Gold is up over 12% for the year. Silver prices are up over 23% for the year. We are in the middle of a gold and silver bull cycle. And we're talking about dollar devaluation that's happening. And the major currency we're talking about is the US dollar, which is the world's reserve currency. Every one of those commodities that you listed earlier is priced in the mighty US dollar. And the theme that this week, we were watching a lot of central bank moves. First, it was the Swiss National Bank that cut interest rates. Then the European Central Bank cut rates. But before that, it was our Bank of Canada. And the Bank of Canada it became the first G7 central bank to cut interest rates in the cycle this week, with a 25 basis point reduction from 5% down to 4.75%. It was anticipated, as was the European Central Bank, but it's a theme of interest rate cuts that we're seeing. Many of the financial pundits said, nope, they're going to keep fighting the inflationary fight. They're going to keep rates higher for longer. That is still the narrative. However, the Bank of Canada did note in their press conference that this is a quote, it is aware that the fight against inflation may not yet have been won. So my question is, so why cut? You're still in a fight. Your main weapon is higher interest rates. Why did you cut, Bank of Canada? Maybe it's the $930+ million loss in Q1. Potentially, I think so. You've lost, and this is the central banks, and we're going to get into more banks later on. Well, but this is total clown show.
Let's just stay on this because Jerry, you brought this up last week, and of course, I was on social media on the conversation boards, and people saying, "Oh, they dropped rates," and the comment I was saying is, "Okay, great, you've dropped rates. Now the dollar's going to drop." Which it already did. It's already gone from 1.36 to 1.37, and it's going to continue to fall. Which means everything you import is going to be that much more expensive. So you didn't get anything from that, right? Then there's also the fact that, and this comes from Globe and Mail, that, for example, a homeowner, their adjustable rate mortgage went down by just under $50 for this. And a first-time home buyer is going to save just under $100 for this. So there's nothing. It's not really any relief to your point. So is it symbolic, or is it because they're losing money and they have to start making moves? Or is this, as Nomi Prinz talks about in her book Collusion, as you've just said, Jerry, you've got Canada may have let it off, but we're already seeing all these other banks around the world doing the exact same thing. So does this go back to originally what Jim Rickards talked about back, when was this? 2016, I think.
Currency wars?
No, well, yeah, but the idea that they were raising rates to have bullets to be able to drop them when there's another crisis.
Yes, and
which
they're not
is
gonna,
A, B, C, or D?
I think a little bit of both, all three. You know, but they're not going to cut rates until they have a justification. And the Bank of Canada did report Q1 losses and its justification, and it's being misconstrued as this going to be a relief rally. Whew, we have a relief. They're cutting interest rates. No, there is usually and I have the data. I can launch this. I could put this out on the X feed. But recessions normally follow. Why? Because you can't just turn down inflation. Inflation, if you're not going to fight it, it's going to continue. And the inflation is having an impact on the GDP. Last week's the GDP in Canada slumped. So this is a classic case of stagflation. When you have economy shrinking, higher inflation, stagflation, and this is the reason why you want to have a mix of commodities in your portfolio.
And lack of policy to actually stimulate the economy and stimulate business, which is what you need. You actually need to stimulate business, not just try to cut it down, stop it in its tracks. The number 18778 silver, the website guildhallwealth.com. This is about holding physical precious metals, actually owning it, actually physically being able to touch it so that you can protect yourself against runaway inflation, runaway printing of money. And these uncertain times, gold is always certain. This is a Real Money Show on 640 Toronto. Stay with us. Welcome back to the Real Money Show. The number 18778 silver, the website guildhallwealth.com. And when it comes to holding physical precious metals, we've been in the business since 2002. One of the vehicles that we use that we launched in 2016, but we're still so excited about it, is owning physical precious metals in your registered accounts. And what makes this so different is that instead of investing in a fund or an ETF or a pool account where you don't really own anything, there may be physical there, but there's a custodian that actually owns it and you're participating in it. That provides counterparty risk. You don't want counterparty risk. If you're going to own gold, you might as well own it yourself. It's like Bitcoin. Why would you invest in a Bitcoin ETF? Why wouldn't you just buy the Bitcoin? It just makes sense.
Right.
So same thing here with the actual physical. So what we do is we help clients to open up a registered account. We work with Questrade. And then we help the client to fund the account, whether they're having to do a deposit or a contribution rather, or maybe they have to transfer from an existing institution. Once the funds are there, we'll help the client to actually acquire the physical product. It'll be deposited into their sub-account with Brinks, fully allocated, meaning the serial numbers are all going to be listed into their own inventory report. And then it's going to show up on their Questrade portal. They're going to get an inventory report to show what they're holding over at Brinks, and their holdings are separate from everybody else. So it's physical gold and silver held in a vault facility outside the banking system. Brinks is not a financial institution. They're a vault. That's their business. Outside the banking system, but still within your registered account. So you don't have to have proxies. You don't have to have different versions of what this actually is. You can own physical gold and physical silver. And I know in the last segment, Jerry, we talked about gold going to $8,000 or more, which is not the largest number we've put out there by any means of what other people are saying. But, you know, Rick Rule is a pretty smart guy. He's done all his research and he looks at how many people really own it. And one of the things he was having a conversation about was what's been driving the market up till now has been central bank buying. But the retail sector hasn't quite gotten involved yet. Now, when the retail sector gets involved and physical metal goes from ownership. I believe he says it's somewhere in the 1.5 range, and it doubles up to 3%. You're going to see massive, massive numbers in the precious metals prices, and that goes for both gold and silver. So when he's talking about gold going to $8,000 an ounce, it's not unfounded. Now you match that with some of the reasons, which is people don't trust the dollar.
Right.
And in uncertain times, what is certain? I don't know, something that's been around for 5,000 years. So what we're doing here on the show is showing all of the moves that they're not going to tell you about on the news, on financial news networks. Your advisor's not going to tell you about. You want to know what in the world is going on with gold and silver that we can start to follow some certain trends. So one of the things I want to track right now, Jerry, besides the financial side of things, because we're going to talk about FDIC and how many banks are on the verge of being insolvent. But let's talk about the COMEX and deliveries, and then we can go into the central banks.
I think it's an important thing to go over because, as you mentioned, this is one-to-one exposure. You're owning physical gold and silver in your portfolio. When we have data out there talking about, you mentioned proxy, what they are derivatives. And there is data that shows there are about 399 paper ETFs versus 1 ounce of silver available, and close to 200 to 1 for gold. There's only 1 ounce of gold available for all of these paper derivatives. And there's not enough physical to back up and keep these papers solvent. So this is a protection against insolvency, against uncertainty. And congratulations to the couple that went to audit their product this week. You know, I implore people to don't take it from us. You know, we do our best to try to be as honest and transparency, which hopefully will build trust and come to Guildhall, but we will go the extra mile. And some of the data that we follow is the deliveries, because all of the derivatives that we get, the 399 ETFs and proxies and certificates and all of these things that represent the easy way that the financial planner will tell you to go, just buy the certificate, just buy the ETF. Well, what we're seeing is vaults around the world being drained, important vaults out of London and New York, 2 places that have this amazing privilege of giving us this silver and gold price.
You mean the exchange vaults?
The exchange vaults.
The vaults that are holding the metal that is used for the derivatives.
That's
for
correct.
The 400 to 1 or 300 to 1. They have to have physical metal in those exchange vaults in order to make these trades.
That's right. And this is important because when we have the London and New York vaults, these exchanges have this amazing privilege of giving us the price. There is a different price happening around the world. It's coming from Shanghai. The price is much higher. It's about 21% higher. As we record, the price of silver dropped down to $29.60. The price of Shanghai is $36. The vaults right now are being drained dry. This is why we follow the story, the Shanghai Gold Exchange versus the COMEX. Yesterday, just this week, the COMEX on Wednesday had 30 silver deliveries. Not a whole lot. LBMA had about 575. How many banks are announcing this Friday are taken over by the FDIC? There's a lot of issues happening because if you don't have the physical silver and the physical gold to back up your contracts, you cannot deliver and thus default on your contract.
When you say deliveries, are you saying product is being delivered to the vault or delivered from the vault?
They had delivered out.
Delivered out. So when you said 575 deliveries, that's 575 deliveries orders to take delivery from that vault.
That's right. So that was on Wednesday, and then yesterday there was 0 deliveries from the COMEX. So there's speculation now. Has the COMEX run dry? Have they run empty? We don't know. But what we do know is months ago when we reported this on the show, when entities went to go audit the nickel, that was one of the major contracts for the COMEX and London Metals Exchange, they went to go visit. What was in the nickel bags? Bags of dirt. So where is the physical silver? Where's the
nickel bag of funk right there?
It's a nickel bag of funk. So this is what's going on, and there's a lot of speculation as to where it's going. It's definitely leaving out of these public hands and into the private sector. And this is the biggest danger, because we're talking about retail. We talk about central bank buying, but the biggest hand is us, the retail buyers. This is why they have a campaign telling you not to buy the physical silver, just buy the piece of paper, because they want to keep you away from the physical.
Okay, so just want to kind of summarize this. The major exchanges in the West, they're having deliveries from the vaults. So that means less and less ammunition to try to keep the price down. And we have massive, massive amounts of paper on top of the physical. Meanwhile, in Asia, they're charging 20% more for the metal, which we can speculate that a lot of this metal that's being delivered from these exchanges is going from west to east. And then we have this story this week that I'd like to get into, that all of a sudden, and everyone's piling on, it looks like China, at least for now, paused on their purchase of gold. But in the meantime, you're seeing all of this metal go from east to west. Is it going into central banks, or is it going to go into retail? And what is it going to leave for people in the West to be able to buy? I'm just going to leave that there. How much is going to be available to buy if all of it is running out of these COMEX and these exchanges? How much is going to be in the retail, and what happens when the retail runs dry? In the meantime, let's get back to the China story.
Yeah, this is more information coming from the Silver Academy, talking about the arbitrage. This is the opportunity where you can buy low here in North America and sell higher there in China and surrounding regions. But this requires the move of the physical. You have to ship it overseas. And so this is a vacuuming of the physical silver, and it's a very finite market, a very small in terms of gold that is available. Silver is being drained. The vaults are being drained. And remember, it's very important to note that the difference between the Shanghai vaults is that the metal has to be deposited on a one-to-one basis. So they're not dealing in these types of promissory notes that the COMEX is doing, where the leverage is 400 to 1. The LBMA vault is down 66% year to date to 300 million ounces of silver. The COMEX vault is down almost 50% year to date to 60 million ounces. Silver physical pricing revaluation is in full force. The Shanghai exchange looks to have the upper hand because he who has the gold and silver makes the rules. And if you don't have the silver, if you don't have the gold, you can't set the price.
I apologize, Jerry. I thought we were finished with talking about the COMEX, but those were very good points to make. The fact that it's one-to-one basis, and a good takeaway that the COMEX is down 60% of their supply. That's very, very important. So something to think about when you're considering buying some physical precious metals. The number 18778 silver and the website guildhallwealth.com. Do you want to talk about what's happening with the Chinese central bank?
Yeah, so there is a big dip in the market today because I believe this report or a chart from the People's Bank of China is being misconstrued as an official report. There is no official report that they have stopped buying gold, and as a result, it's causing the markets to dip. And Monday, China has another banking holiday on Monday, so this could be another buying opportunity. Definitely buy the dip. Remembering, though, China was involved in 18 months of straight purchases, and this is official coming from the People's Bank of China's reports. There is no report on a halt. This is, in my opinion, a pause, and it's definitely a word that the U.S. Federal Reserve and the Treasury Secretary uses, transitory. I think it's transitory. They haven't stopped. But what is continuing is world central banks. Remember, bigger picture, bird's eye view. It's just continuing. Well,
I think the difference here is there's a difference between the word pause and halt, right? It's like saying, that the market's being slammed down when it goes down 20 cents in silver. That's not really a slam, but it sounds good. So if you say, oh, they've halted, that seems a lot more definitive than we don't know that they've halted. They don't give us that information. They're not making a statement about that. They haven't recorded that in a newspaper anywhere. It's just North American media saying, oh, they've halted because we saw a chart. You don't know that. We don't know if they've halted or paused or if it's in fact transitory, and you're just taking that information from a chart. So to your point, let's keep watching all the other central banks. And I think that the major thing that you want to take away from this is what Vince Lanci said about it.
Yeah, Vince had some reasons as to why that China may have stopped or paused. The top 3 reasons: the COMEX has run out of gold and silver. No places to store it.
So you can't take delivery if your supplier is out of product.
Yeah, that's right. Maybe there was some, the West has stopped accepting the yuan. There is currency wars continuing.
We can't send you any because we don't accept your payment.
Right. And there's more news on that regarding the petrodollar being swirled around this weekend. In the next segment, we'll get into that. Silver is cheaper, so they may be switching, just like they're recommending the people to do in China. Central bank may be going after the silver market next. And thirdly, JP Morgan begged them to stop. I think that was a joke, but Vince Lanci, we're following that. Thank you so much for the info. And this is definitely a story we will be watching and sharing with our clientele and listeners.
The number 18778-SILVER, the website, guildhallwealth.com. Give us a call. We'll show you how to get involved in the physical gold and silver market. You can go to our e-store, guildhallpreciousmetals.com, pick up a tube of silver maples, your first ounce of gold, give it a try, hold it in your hand. You'll see that it's a great, great market to be a part of. Or you can even put it into your registered account. Again, give us a call, go to the website. You'll see how it works, and we're happy to hold your hand and walk you through the process. The number 18778-SILVER, the website, guildhallwealth.com. It's The Real Money Show on 640 Toronto. More to come. Welcome back to The Real Money Show. The number 18778-SILVER, the website, guildhallwealth.com. We're always recommending a crawl, walk, run strategy if you've never been involved in the market before. Jerry's okay. We were talking in the office. We're like, I don't think it's time to crawl anymore.
Just jump in, guys.
just start jumping. No, but it's all about going through the paces, right? You need to go through that first purchase, because I notice, and I'm sure you would agree, Jerry, that many people who are acquiring for the first time, they are bringing an investment mentality to it. And when it comes to investments, there's no costs. I like a stock, it's trading at $25. What's it going to cost me? $25. But this is more like asset investing. Yeah. I say investment, but asset ownership. If you think about a property, if a property is $1 million, you're going to pay your agent, you're going to pay land transfer, you're going to pay a lawyer, there's closing costs, That $1 million property cost you $1,080,000, something like that. Mm-hmm. And now, what would you do? Go to your broker the next day and say, I want to sell?
Right.
Your agent is going to say, okay, let's list it at $1 million. You're lucky if you'll get $950 after costs.
After all that.
Because the agent's going to get paid again. Right?
Legal.
You didn't pay the land transfer. You didn't pay those additional costs. It's very similar in precious metals. It's a retail asset. There's lumber, and then there's a desk. Someone had to buy the lumber, produce something with it, send a wholesaler buys it, a retailer retails it. Mm-hmm. So this is a retail product. And so learning about those costs of doing business, I feel, is half the battle. Because what happens is when we're buying for the first time, we're very price conscious. We're very price conscious in the beginning. And I'll tell you why. Because it's the only thing, if I'm new to a market, that I can control. And it's also happening in a market that we can't control the price. If you go to buy a car, you can say, well, it's a $30,000 car, but what can you do for me, right? In the metals market, it's a car that might be $29,000. Mm-hmm. It could go up to $32,000 the next day. And if you don't jump in and buy a few of the tires, you could wake up and it's already trading at $40,000.
Correct.
So, and your car salesman can only do so much if it's at $40,000. So the idea is that the crawl, walk, run strategy is really about getting your feet wet, understanding what the product looks like, what the costs are, what it feels like to have it in your hand, and these sorts of things, to walk through the paces. It's not, well, I'll buy some today, and then I'll see you in 2 years when I'll start crawling or
That's
walking.
Right. Well, I appreciate the person and the ones who get what's going on, who can see the desk and the collage of articles and sees the argument for metals and just jumps in. But I definitely appreciate the crawl, walk, run approach because it gives people the opportunity, understanding when trust is down the drain and you know, you have to do due diligence. Yes, crawl, walk, run to poke holes in this thing. Poke holes as much as possible. We are here to handle your objections. We're here to handle you in this market. Talking about the entrance and potential exit in the market, we're here to walk you through this. So I appreciate both approaches, but for me, I'm a jumper. I'm jumping right now.
I don't get that many objections in the market these days, I have to say.
No,
it's more about just helping people understand what, the details of it and how it works specifically, right? Even if it's just what's the difference between spot price and retail price, or why is there a difference between this brand or that brand when they're all LBMA approved, right? These are the things that you want to get your feet wet with to understand. Okay. That said, FDIC, Federal Deposit Insurance Corporation, they came out this past week, and they are very, very concerned. Or should I say very, very, very concerned? Maybe it's 64 varies, I believe.
63 varies.
63 varies.
Yes. So the FDIC just reported, this is coming from CFA WinSmart on X through Silver Academy. The FDIC, which is the Federal Deposit Insurance Corporation covering all of the deposits in the United States, just reported that 63 banks are on the brink of an insolvent collapse. Unrealized losses on available for sale and held to maturity securities soared by $39 billion to $517 billion, $500 billion in the first quarter. This surge was driven by higher unrealized losses on mortgage-backed securities, a result of rising mortgage rates in the first quarter. While the FDIC also stated it acknowledged that the $517 billion in unrealized losses, along with other factors like persistent inflation, volatile market rates, and geopolitical concerns, could lead to credit quality, earnings, and liquidity challenges for the industry. This is Q1 stuff, Jeremy. We're just in the first quarter. This is just like the Bank of Canada reporting a huge, almost $1 billion loss in the first quarter.
How does this relate to precious metals? So someone says, "Oh, okay, there's 63 banks in trouble. What do I care?"
Well, this is the
They all get bailed out, don't they?
You can't just print. This is the debt. The debt situation was the problem that got them in this place. In the first place, you printed too much currency to bail this person out and that entity out and this bank out over and over again. You're now just flooding the system with worthless paper. Remember, it was reported last week a record of 9.3 trillion of U.S. debt will mature within this year alone, and further on the debts.
Oh, so if the debt's maturing, then those banks are going to be in real
rollover
trouble.
Happens this year, Jeremy. The U.S. interest expense has crossed $1 trillion. It's expected to hit $1.7 trillion next year. The U.S. debt crisis is here. This is a major concern for these banks and the FDIC.
If there's a debt crisis, why gold?
Gold is your escape from bubble territory. All of these debts, all of the assets that have been ballooned because of the debt, gold is your protection against counterparty risk. And when the markets dry up and the markets move from the Exter's pyramid down into the finite gold and silver market, you want to be where this is going to be, because what's going to happen next, the U.S. will cut interest rates. And when it does, that's going to be the pinprick to the bubbles, and gold and silver will begin its ascent into the peak of the third gold cycle.
So it's one part protection, and more importantly, the opportunity that's going to happen when everybody's trying to get their physical gold and the price is going through the roof, and silver is going to take off even more than that. The biggest story is going to come up in the next segment. We've talked a lot about buy gold with a but, buy silver with a but, meaning the reluctant mainstream media talking about why you should own precious metals. Stay with us. The number 18778 silver, the website guildhallwealth.com. Big story coming up in the next segment. Stay with us. We'll be right back. Welcome back to The Real Money Show, the number 18778 silver, and the website guildhallwealth.com to learn about holding physical precious metals in your portfolio. Get involved in the market. We're going to see big things moving forward. This isn't just about protecting yourself against 63 banks going under in the States and other financial issues that are going to pop up, but the opportunity of when the price goes through the roof in the precious metals. One thing before we jump into the next part, Jerry, did you see this week that Apple, Microsoft, and NVIDIA combined are worth more than the Chinese stock market?
That is just insane. Talk about crowding and talking about just, how can just three companies? This is a huge bubble waiting to explode, and this is what we're seeing here. We got to pay attention to this. This is important stuff.
Crazy exuberance in the market. Okay, if you've been listening to the show recently, which we know you have, we've got very loyal listeners, then you know that we've been talking about and showing articles where the mainstream news with regard to financial stuff has been very reluctantly recommending precious metals. They're saying, look, you can buy silver, but it's going to be a very quick rally, and they'll quickly learn how to use a different metal instead of silver, right? Jerry, tell us about your conversation this week with that regard.
Yeah, just bring up the article that I brought up last week. TD Strategist says that the move up in silver is going to be temporary because the tech companies that rely on silver can just switch to a different metal. They've been saying this since 2016. Why haven't they done it? So I had a conversation this week with the chief engineer with 40 plus years of experience in steel, metallurgy. He's actually an advisor right now for emergency services vehicles, for fire departments, ambulance department, and the medics. And he's a technical writer. Basically, he's like, you can't replace silver in these industries. You cannot replace it. And all of the writers from, these strategists is just hogwash. So, dismiss what they're saying. You cannot replace gold and silver. It's irreplaceable.
Yeah. So it's, again, that kind of buy it, but beware, right? Morality tales and things like that.
Exactly.
Biggest news of the week came out of Forbes.
Forbes had another headline and an article that he wrote. Believe it or not, the world is lurching toward a new gold standard. And this came out with a lot of appeal because this is the solution that we're talking about. But he nails the nail on the head here. He hits the nail right on the head. He writes that no monetary system today is held in such contempt among almost all economists and financial officials as the gold standard. The U.S. was on one for 180 years until the early 70s, and it worked. We never experienced inflation while the dollar's value was tied to the yellow metal. And the U.S. had the greatest long-term economic growth in human history. Since the greenback's link to gold was severed, our average historic growth rates have fallen by about 1/3. Nonetheless, the contumely and scorn for gold is universal. Events have a peculiar way of forcing things once unthinkable into the forefront of consideration and then into reality. This segment of What's Ahead lays out the unmistakable signs of change, starting with the startling fact that recently central banks have been buying gold at a record pace. It's just, again, this is a continuation of, why is there so much contempt for the gold market? Why are economists hating the gold market so much? Financial, bankers. The same chief engineer was told by his planner, we're finishing this conversation. No discussion about gold. I can't help you with that. Why is it so hated, Jeremy? In my opinion, it is hated because it limits greed. Your thoughts on that?
I think it's part of the system that was created when you severed the gold from the fiat currency and made it fiat by decree. You handed all control over to those financial beings, and they profit off of all of that. And when you remove physical gold and silver, you remove your cash and put it into those assets, there's no counterparty risk, and you're forcing discipline on the financial institution. I would say that's where gold and Bitcoin people can definitely agree on those things, because that's what a lot of the Bitcoiners say that they want. And it's kind of like saying, look, I've got someone who has an eating problem. They eat too many sweets. They're obese, and I'm going to take away all the sweets from the refrigerator. I'm not going to have any in the house. They can't have it. That's going to create the discipline. And that's what you do when you're taking physical gold and silver out of the banks, or you're taking your money, the fiat money, and converting it into metals. They can't take anything. They can't do anything with it. Greenspan said the only thing that can stop inflation is when you have something nailed down, and that's physical gold. And to your point about moving back to the central bank, I'll use another quote from Winston Churchill. The U.S. never failed to do the right thing after they've exhausted all other possibilities.
That's what's happening.
That's what's happening. We've got 1 minute left. Do you have something that you want to leave it till next week?
No, I mean, we can get into this right now. We have 1 minute. What's the deal with the petrodollar? I know everyone's talking about this, is swirling around that the agreement, the 50-year petrodollar pact that was signed in June 6 of 1974. This is what backed the U.S. dollar after the gold standard was the oil that they signed into an agreement with Saudi Arabia to sell all the oil in U.S. dollars. Apparently, there was news that this could expire June 9th. But there is no deal. There's no such, doesn't appear to have an end date. However, Saudi Arabia has announced with the BRICS that they will be joining the Bank of International Settlements and Bridge Payment, thus leaving the petro system as the only system for energy. So this is de-dollarization, converting out of paper currencies out of the U.S. into physical assets, including gold and oil.
And if you want to get out of the financial system and the risks involved in that, at least in part, to give yourself a bit of that insurance policy, give us a call. The number 1-877-8-SILVER. The website, guildhallwealth.com, will show you how to hold physical gold and silver directly in a vault or in your registered account. If you've missed a show, check us out on YouTube. Check us out on Rumble. We'll also post the show to Spotify. And check us out on X throughout the week, because all of these articles we're posting there as well. So you'll be the first to know what's happening in the markets. Thank you so much, Jerry, for joining us and giving us all this great information. And thanks to all our listeners for joining us this week. We can't wait to speak to you next week here on The Real Money Show on 640 Toronto.